Hi there, Greg Lewis, Metastock Software. Hey, you're about to watch a recording of the April 2017 Online Trader Summit presented by Metastock. This quarterly event, put together by our own Jeff Gibby, highlights some of the industry's best traders, and I know you're really going to enjoy it. Hey, if you haven't tried Metastock yet and would like to have an extended 3-for-1 trial, visit metastock.com/traders-summit 3-for-1, or just click one of the things provided and get your free trial. Thank you, and I hope you enjoy the presentation.
Chuck Hughes is our next presenter. Chuck Hughes is not going to disappoint you either. I hope you're enjoying the presenters today. Chuck Hughes has been trading for a really long time. We've been working together for a number of years too. I remember back when I lived in Boulder Creek, going down and visiting several times. He lived in a beautiful place down on the coast in Northern California, or actually it's Central California. Chuck can say that he's won many championship trophies. He's been 8 times. He's been first place in this contest he participates in every year. I'm going to mute it for a second. I got cough. But in any case, he's a great speaker. He's got a very specific way he likes to trade options in the market. And let's go ahead and bring him on. Chuck, I'm going to turn on your microphone now, so you're warned. Chuck, can you hear me?
Okay, good. Okay, good. Can you hear me, Jeff?
You sound great to me. Now let's get your screen over here. I'm gonna. It should ask you if you want to share your screen. I'm gonna confirm that I can see it before I let you go.
Okay.
So what do you have to say about yourself? I can see your presentation in a non-presenter mode.
Okay, and I will put that in presenter mode right now. Can you see it now?
It looks perfect.
Okay. All right, awesome. Well, thanks, Jeff, and thanks for inviting me to the Trader Summit. I always enjoy doing these educational webinars, and over the years I've gotten a lot of questions, and I would research the question after the webinar, and then that's how I actually came up with some of my strategies. So I enjoy doing these webinars, and I actually learn things too. So today I want to talk about trading options for high returns with low risk, and we're going to look at trading option spreads versus directional trades. And whenever we have a profit in a directional trade, whether it's a stock or an option, we always protect that profit by using options so that we can protect the profit. In some cases, we can actually guarantee a profit for the trade, and I'll show you some examples of that. So whenever we have a profit in an option, we always protect it by creating a spread trade. And let's look at the risks of trading options. In general, when you buy a call option, the underlying stock must increase in price above the strike price of the option at expiration, or you'll incur 100% loss of the option premium. So let's look at an example. This is a option chain for Facebook. Facebook stock was trading at 132.07 at the time. So let's say we were going to buy the 135 strike call. We can see that was trading at 310 bid, 315 ask. So if we went ahead and bought that option, Facebook stock would have to close above 135, or you would incur a total loss of the $315 premium. So that you're always facing a 100% loss whenever you buy an option. So we always keep that in the back of our minds, and we're always looking to create a spread trade whenever we have a profit in a call option trade. This is a snapshot daily price movement of the VIX, the volatility index or the fear index, and over the last couple of years, the market's been fairly choppy. Back in 2012, 2013, and 2014, the market trended pretty well, and it was a lot easier to make money with options. But the last couple of years, it's been choppy. There hasn't been a straight trend up the last couple of years, and each one of these spikes in the VIX index, of course, represents a sell-off in the stock market. So if you had bought a call option and you had bad timing during any one of these sell-offs that you see here, then you could have been stopped out of your trade. So we're going to show you how we reduce that risk of entering an option trade, and with the goal of preventing yourself from being stopped out of the trade. And unlike directional trades, option spreads can profit if the underlying stock increases, decreases, or is flat. So if you in a directional trade, of course, the underlying stock has to go up, and it has to close above that strike price at option expiration, or you're going to lose 100% of your premium. But option spreads can profit if the underlying stock is up, down, or flat. And we're going to look at a little known option spread strategy that we use that can literally eliminate the risk of your trade and guarantee a profit. And I'll show you actual examples of that. So let's talk about our directional trades first and how we select trades. And we use what we call Prime Trade Select to select an option directional trade. And there's 3 steps in Prime Trade Select. And there's a Metastock module available for Prime Trade Select that will comb a database and then come up with trades that qualify under Prime Trade Select. And once we enter a directional trade, then we have 3 simple rules to manage that directional trade. We always exit losing trades quickly before they turn into large losses. We don't exit a winning trade with a small gain, and then we use options to protect profits. If we get a profit in the trade, then we'll use options to protect those profits. So once we enter a directional trade, we'll exit quickly, and I'll show you some examples of that. We'll exit quickly before it turns into a large loss, and we won't exit a winning trade with a small gain, and I'll show you how you can do that and at the same time protect your existing profit. And we're going to show brokerage account statements that show 1.9 million in actual close trade profits using Prime Trade Select and the option spread strategies we'll talk about today. And we also have a snapshot of open trades, and that shows 1.2 million in open trade profits using Prime Trade Select. So as a little bit about our background at Optioneering, we have over 60 years of combined trading experience. We started teaching option strategies to other traders 21 years ago. Prior to that, I just traded on my own, and about 21 years ago, I started teaching my option strategies. I started out trading options with a $4,600 trading account, and then in my first 2 years, I had over $460,000 in profits, which is more than I made the previous 6 years as an airline pilot. So these are just my tax returns those first 2 years that I was trading options, and these show those first 2 years I had $460,000 in profits. And the Optioneering team, we've received a total of 13 of the World Trading Championship trophies, including 8 first place, 4 second place, and 1 third place trophy. And I won the World Trading Contest 8 times, which is more than any other trader. And that's a real money contest, and the results are audited before they're posted on the sponsor's website. So These are real-time returns. I took first place with a 309% real-time return recently, and the year before that I had a second place with 339% real-time return. So we're just showing these profit results so you can see that the strategies really do work. Okay, let's talk about Prime Trade Select. And step one in Prime Trade Select, and we're talking about now when we select our process for selecting directional trades. And the first step is to determine the price trend of a stock using the 50 and 100-day exponential moving average system. And then step two is we select the low risk entry point using the Keltner channels, and I'll show you some examples of that. And step three is we use what we call the 1% rule to select the option strike price with a high probability of success. So these three trade management rules, of course, the 1% rule is just as important as selecting the option itself, because you have thousands of strike prices to choose from in a lot of those liquid stocks. So the 1% rule is just as important as the actual trade selection, because it allows you to select a strike price with a high probability of success, and we'll show you some examples of that. So for step one, we determine the price trend. We use an EMA trend following system to determine the price trend, and the goal of the EMA system is to quantitatively measure the buying and selling pressure of a stock, and it allows us to follow the trend instead of trying to predict the trend. And we like to use trend following, a trend following system instead of making emotional decisions, and we've been using trend following successfully for more than 30 years. The trend following worked well in the 2002 and 2008 bear markets when we had short positions. So in my personal account and in my advisory services, we were heavily short during the last two bear markets, and we were able to do well. So it's a very simple trend following system. If the 50-day exponential moving average is above the 100-day, then that stock is on a buy signal, and if the 50-day exponential moving average is below the 100-day EMA, then that stock is on a sell signal. And if a stock is on a buy signal, we'll purchase the stock or a call option, and if the stock is on a sell signal, we'll purchase ETFs or put options on the stock. And as I mentioned, the trend following works in both bull and bear markets. Right now we have bullish positions, but we're always looking for a trend change and to switch into bearish positions if we start to enter a bear market. So let's look at an example of a buy signal with the EMA system, and this is a daily price chart for Cigna, the insurance company, and these red and green vertical lines, this is the daily price movement of Cigna stock, and the blue line right here is the 50-day exponential moving average, and the red line is the 100-day exponential moving average. So we can see right back here, the blue line actually crossed above the red line. So at that point, Cigna stock was on a buy signal, and as long as the blue line stays above the red line, which is the 100-day, then that stock remains on a buy signal. Here's an example of a sell signal. This is for the China ETF, and we can see this is the daily price movement of the ETF right here, and the blue line again is the 50-day EMA. We can see right here it crossed below the red line, the 100-day EMA. So at that point, the China ETF was on a sell signal, and again, as long as that blue line remains below the red line, then that stock or ETF is on a sell signal. Okay, so first we determine the price trend, and if the stock is on a buy signal, we're going to buy a call option. And what we like to do is select a low risk entry point, and we use the Keltner channels to select our entry point. They're similar to the Bollinger Bands. I found for our purposes that the Keltner channels are a little more accurate, so we prefer using the Keltner channels. And here's an example of the Keltner channels. They're an overbought, oversold indicator. This is daily price movement for Home Depot stock, the red and black vertical lines here. And then there's three Keltner channels. There's the upper channel right here, and the middle channel is this dotted line right here. And then, of course, we have the lower channel. And the channels act as an overbought, oversold indicator. And you can see when the stock is trading near the upper channel, then it's getting overbought. When it's trading near the lower channel, it's getting oversold. So we like to use these channels to time our entry. And here's an example of this again is the daily price movement of Home Depot stock. So what I did is I circled the price movement when it got up or above that upper channel. I circled that. So obviously you don't want to buy when it's trading up near that upper channel or above the upper channel. You want to wait for a retracement to the middle channel, which is the dotted line, or the lower channel. So we will wait and time our entry, and you can see Home Depot stock here got overbought because it was near the upper channel, and of course once it gets overbought, then the odds are it's going to retrace. So we can see overbought, retraced, then it became oversold and it rallied, got up near the upper channel again, overbought, it retraced towards the middle channel, overbought, retrace, overbought, retrace, overbought, retrace, overbought, retrace. So we'll wait for a pullback. We'll watch a stock and wait till it pulls back to this middle or lower channel. So let's look at an example, and in these examples, notice how the stock rallied after we purchased the call, producing a profitable trade. And so we use these Keltner channels to enter a trade. Here's an example for Amazon, and this is the daily price movement of Amazon right here. And what we're showing, this is our brokerage account transaction transaction history for an Amazon call option purchase we made. We bought 2 of the Amazon 330 strike calls at 113, and that was right in here. So you can see Amazon's been on a very strong price uptrend, and generally will retrace towards the middle channel and then resume the rally again. So we were following this, and then we waited until it got right in here in the when it retraced to the middle channel, and we bought the 330 strike call at 113, and then the stock rallied after our entry. So we got a good entry on that trade using the Keltner channels. Now this option has since expired, but we roll over our expiring options if the stock is still on a buy signal. So we still own Amazon call options. It's rallied quite a bit since this initial position that we took in Amazon. So we use the Keltner channels to look for low risk entries. Here's another example. This is for Starbucks, and you can see when we took this snapshot that Starbucks was in a strong price uptrend. and when it got overbought, it normally retraced to the middle channel. So we were following this, and then right in here, we pulled the trigger when it retraced to the middle channel. We bought 14 of the Starbucks 40 strike calls at $13.75. So this is just another example of timing the entry, and then this trade worked out because the stock continued to rally after we purchased the call options. And when you do this, if you can get a low risk entry, then that helps you prevent being stopped out of the trade and results in higher accuracy trading. And once we decide that we're going to purchase a call option, we use what we call the 1% rule to select the option strike price. And once you decide you're going to buy a call option, we normally trade fairly liquid stocks or ETFs. So once we decide we're going to buy a call option on a stock or an ETF, there could be hundreds or even thousands of strike prices to choose from. So selecting the strike price is just as important as the trade selection itself. So option premiums consist of time value and intrinsic value, and options lose all of their time value at option expiration. So whenever you buy an option, you're buying a decaying asset. So you want to keep that in mind. And each day, an option is going to lose some time value, and then, of course, when you get to expiration, it loses all time value. So we keep that in mind, and due to these time decay characteristics of options, when you buy an option, you want to minimize that time value because that's going to decay to zero, and you want to maximize the intrinsic value. So what we do is we'll limit the time value portion of that option to less than 1% of the strike price. And if you do that, then you'll minimize the time value, which decays to zero, and you'll maximize the intrinsic value. So as an example, if you purchase an option on a stock that's trading at 100, you want to limit the time value portion of that option to 1 point or less. That would be 1% of a stock trading at 100. So if you're buying a call option on a stock trading at 100, you want to limit that time value portion of the option to 1 point or less, which would be 1% of the stock price. So if you limit that time value to 1% of the stock price, the stock only has to go up 1% in order for the trade to break even and for you to start making money. So this will have a much higher probability of success than a strike price that required the option or required the underlying stock to go up, let's say 6 or 10% in order to break even. So the stock only has to go up 1% and we start making money. So that obviously is going to be much higher probability of success than a strike price that requires the underlying stock to go up 6 or maybe 10% in price just to break even. And a lot of times the underlying stock, it won't make that expected price move. It has to go up 10% before option expiration, or you're going to lose 100% of your option premium. A lot of times it won't make that move, and you'll lose 100% of your option premium. So we use this 1% rule, and that deleverages options a little bit, and your percentage profit potential is less with an in-the-money call than it is for an at-the-money or out-of-the-money call, but it's a trade-off. You have a higher probability of a win on your option trade. So let's look at an actual example. Our transaction history shows that we bought the DVY, that's the dividend ETF. We bought the September 70 call at 11.70, and at the time DVY was trading at 81.38. So we bought the 70 strike call, the stock trading at 81, so that was an in-the-money call option. And let's look at the math on this and how you can calculate this time value portion of the option. So the stock was trading at 81.38. We bought the 70 strike call, and so the intrinsic value of this option, we paid $11.70 for the option. So the intrinsic value is calculated by simply subtracting the strike price from the stock price. So we hit this option that we paid $11.70 for had an intrinsic value of $11.38. And then you take the total premium, in this example $11.70, you subtract the intrinsic value from that, and you can see that this option had a time value of 32 cents. And what that means is the DVY ETF only had to go up 32 cents, and this trade would break even and start making money. And we have a series of option calculators for all of our option strategies, and what these do is they calculate the profit potential for the option, assuming various price changes in the underlying stock at option expiration. In this example, from a 30% increase in the stock to a 5% decrease in the stock at option expiration. So these will calculate the profit potential with these various assumptions. So here's the analysis for the call option purchase. DVY ETF was trading at 81.38. We bought the 70 strike call at 11.70. So we can see that if the stock is flat at 81.38 at option expiration, we only lose 2.7% on the option. That's a lot better than losing 100%. So if we bought an at the money or out of the money call and the stock didn't trade above the strike price at option expiration, then we would show 100% loss here at expiration. So, and we can see that if the DVY was up 10% at expiration, this trade would put profit 66% with a 10% move in the underlying stock. 20% move in the underlying stock would be 136% return. So even though we deleverage the option a little bit by selecting an in-the-money strike price, these are still good returns. If the underlying stock goes up in price, these are good returns for this option trade. So again, with only 32 cents of time value in this example, the DVY ETF only has to increase 32 cents, and that's 0.4%, and then this trade breaks even and we start profiting on it. And again, when you use this 1% rule, that it'll be a much higher success rate than buying at the money or out of the money calls that require a 10 to maybe even 15% move in the underlying stock just to break even. A lot of times that's not going to happen and you're going to lose 100% of your option premium. Okay, so once we select the directional option trade, then we have 3 trade management rules. We exit our losing trades quickly before they turn into large losses, and we don't exit winning trades with a small gain. And I'll show you how we don't have to exit our winning trades with a small gain because we'll create a spread. So, and then the third rule is we use options to protect any profits that we have on winning trades. So the trade management is just as important as the trade selection. You want to exit a losing trade quickly, and if the trade works out and you have a profit, then you want to use options to protect those profits. Here's a snapshot of some recent closed trades that we took. And this this column right here lists the profit we had for the trade, the profit or loss that we had for the trade, and here's the second part of that snapshot. So this column right here, the column on the left, of course, has the stock, the strike price, what we opened the transaction at. In this case, we bought the LNG 40 strike call at 12.60. We closed it out at 24.10. We had a $6,882 profit on this. So what I did was I tallied up the losing trades in those closed out trades and compared them to the winning trades, and to demonstrate that you don't want to exit or you want to exit losing trades quickly before they turn into large losses. So in these examples, in these two snapshots here, our average losing trade was 14%. So we'll look to get out of an option trade. If we get up near a 20% loss, we'll exit. We were wrong, and we will simply exit before it develops into a large loss. And in this example, we exited, and the average loss was a 14% loss. So by not exiting winning trades with a small gain, we had an average winning trade in this example of 136%. So we had an average losing trade of 14%, and we had an average winning trade at 136%. So that's why you don't want to exit your winning trade with a small gain, because the winning trades can mitigate your losing trades. And for example, we only had to win on 1 out of every 8 trades in order for the portfolio to profit. So this is an example of why we don't exit with a small profit, because we want to hold on to the option and get a big winning trade. And if you do that, then you don't have to win on that many trades in order for your portfolio to profit. So we exit quickly with losing trades and hold on to winning trades. And of course, if you incur a 20% loss on your option trade, it takes a 25% return on the next trade to break even. If you incur a 50% loss, then your next trade you have to have a 100% win in order to break even. So how many 100% wins have you had lately? So we always exit losing trades quickly, 20% or less, and then hold on to the winning trades. And here's an example. This is this is a snapshot of open trade profits. We have 2 accounts. This is my larger retirement account, and this column lists the option that we bought, the quantity, the price we paid, the last price, and then our dollar profit and percent gain. So this is just an open trade snapshot. This retirement account had a $961,000 open trade profit using Prime Trade Select, and my smaller retirement account had a $247,000 open trade profit. So those trades were selected using Prime Trade Select. So Prime Trade Select has produced a lot of winning option trades, and whenever you have a winning trade, you always face that dilemma, well, should I get out in case the stock goes down and that winning trade turns into a losing trade? But then if you exit a winning trade and the stock keeps going up, then you leave profits on the table. So we solve that dilemma by simply buying a put option to protect our profits. And we know that as traders, it's very hard. If you have a winning trade and all of a sudden it turns into a losing trade, it's hard to stick with your program, because it's hard on your psyche as a trader, and you could lose confidence in your ability to be a successful trader if you let a winning trade turn into a losing trade. So we simply buy a put option to protect our profits. And the put options, of course, profit if the underlying stock declines in price. And whenever you have a winning call option trade, purchasing the put gives you insurance against a loss on your call option in case the underlying stock declines in price. Now, at the same time, purchasing a put option does not limit your upside profit potential of the call option if the underlying stock continues to rally in price. So that solves that winning trade dilemma. You're locking in a profit, and if the stock continues to go up, you don't have a cap on your upside profit potential. So again, this allows us to use our money management rules, and it's been working out very well, especially in choppy markets like we've had the last couple of years. So by purchasing that put option, you can even guarantee that you'll have a profit on your call option, and I'll show you some examples of that. So once you buy that put option protection, you can forget about the trade until option expiration. You don't have to monitor the markets or world events. You don't have to place a protective stop in there. Once you buy the put option, you can forget about the trade until option expiration. So bad earnings reports don't matter. Severe sell-off in the markets don't matter, because once you put that protection in place, then you can just forget about the trade. So when you have a winning call option and then you buy a put option, we call this a market neutral spread, because the call option, of course, profits if the market goes up, and the put option profits if the market goes down. So we call this a market neutral spread, and it's a very low risk way to trade options. And again, if we have a losing trade, we simply exit that losing trade and move on to the next opportunity. If we have a winning trade, then we want to protect those profits by buying a put option. And these market neutral spreads can profit if the price of the stock goes up or down. And a sharp decline in the price of the underlying stock can actually result in a windfall profit with these market neutral spreads, and I'll show you some examples. And your total risk is limited to the cost of the spread. Okay, let's look at some examples of market neutral trades. We use Prime Trade Select to purchase a Home Depot call option. We got a low risk entry using the Keltner channels. We used the 1% rule for selecting the strike price. That produced a profitable trade, so we legged into a market neutral spread in this trade by buying a put option. So here's a portfolio snapshot that shows that we bought 45 of the Home Depot 80 strike calls at 10.15, and that produced a $120,000 profit. So what we did is we purchased a put option on this, and we usually purchase the put options maybe 2 to 3 months out, and then when that put option expires, then we just roll over into a new put option for protection. So in this example, we had $120,000 profit, and we the put option protection we had in place was expiring, so we went ahead and bought the 110 strike put option at 420. So this shows that we bought 45 October 110 strike puts at 420. And here's a snapshot. Open trades at the time. We bought 45 80 strike calls at 10.15. We bought 45 110 strike puts at 420. And we have a calculator for these market neutral trades that will calculate the profit potential for the spread, assuming various price changes in the underlying stock at option expiration. So here's the market neutral calculator, and again, this is for Home Depot. The stock was trading at 115 at the time. We bought the 80 strike call at 1015, and then we legged into the 110 strike put at 420. So in this example, the calculator will calculate the profit potential from a 30% increase in the underlying stock at option expiration to a 100% decline. Now, of course, we don't expect a big decline in a stock like Home Depot, but I just put this in here to show you how this market neutral spread strategy works. So let's look at in this column right here, if the stock is flat at option expiration at 115, we'll have a $2,082 profit and a 145% return. If the stock goes up 10%, we'll have a $3,200 profit and a 225% return for the spread. Now, if it goes down 40%, which I would not expect it to do, but you can see that if the stock takes a severe dip, you're still going to profit. In this example, if the stock went down 40%, we'd have a $2,600 profit in the spread and a 185% return. So in this example, we were able to lock in the minimum profit. In this example would be 145%, and that's if the stock was flat at option expiration. So in this example, we had a guaranteed profit of 145% return in for this trade in Home Depot. Here's one more example. This is for the healthcare ETF, symbol XLV. We own 64 of the January 50 calls at 960. We had a profit in it, so we legged into a market neutral spread by buying the 75 strike put at 4 points, and we bought 64 of the January 75 puts at 4 points. And here's the market neutral calculator for this trade, and if the XLV was flat at option expiration, we'd have an 83% return. If it was up 10%, we'd have a 110% return. And if it was down 40%, which I would not expect, we would still profit on this trade. And notice how with these market neutral spreads, it doesn't put a cap on the profit potential. So if it's up 10% at expiration, we have 110% return. If it's up 20%, we have 162% return. So these spreads don't put a cap on your profit potential. And at the same time, if the underlying stock or ETF goes down, you can still profit. Okay, here's a snapshot of a portfolio of market neutral spreads. This is for Cigna, Costco, J&J, Starbucks, Wells Fargo, and Yahoo. And this is the open trade snapshot. In this column here lists the profit, the open trade profit for the option and the percent return. So this was a portfolio in one of my smaller retirement accounts, and what I did was I used that market neutral calculator to calculate the profit potential for each one of these trades, and then I combined that into how the portfolio would do as a whole. So I used the market neutral calculator, calculated the profit potential for these trades, and here's what we came up with. If the stocks in this portfolio, the underlying stocks, if they were flat at option expiration, this portfolio would have a 277% return. If the stocks on average were up 10%, then we'd have a 711% return for the portfolio. So this is the portfolio the total portfolio, and these would be the average returns. And if the average stock went down 20%, then we'd have a 1,200% return. So this is just demonstrating that if you have a portfolio of market neutral spreads, what the return potential can be. So again, with this portfolio, we're guaranteed a profit by buying those put options, because you can see the minimum return that we get for the portfolio is 277%. So the strategy this is a great way to invest in options, this market neutral strategy. It's very low stress, very low risk. So we like to use this strategy, and you know, if you have a highly leveraged option portfolio of directional trades, a sudden market decline that you didn't expect could wipe out that portfolio profits quickly. So we've seen too many times where we had a call option portfolio, and we had nice profits in it, and all of a sudden there was a sudden market decline, and we didn't have that put protection, and then all of a sudden those profits turned into a loss. So that prevents these trades from turning into a loss by simply buying the put option to protect them. Okay, again, a very low risk, low stress way to trade. So this is one of our favorite strategies, the market neutral spreads, where we leg in to the spread by buying a put option. And that portfolio I showed you previously with the 6 market neutral spreads, if you bought just one contract of every one of those call and put options in that portfolio, the total cost would have been about $1,715, and that's after commission. So you can trade these market neutral spreads in smaller accounts. And what I'm going to show you lastly here is our closed trade profits, recent closed trade profits of $1.9 million. And these trades are a combination of prime trade select directional trades and market neutral spreads. So for Apple, we had $356,000 in closed trade profits. For the financial ETF, the FAS, we had $426,000 closed trade. Home Depot, $296. Netflix, $23,000. TJX, the retailer, $35,000. And the NASDAQ ETF, the triple Qs, we had $590,000 in closed trade profits. So you can see these strategies have been doing pretty well. The healthcare ETF, we had $221,000 in closed trade profits. Okay, so we have an advisory service, and we make trade recommendations for our option strategies. And what we do is we send out an email if there's a new trade recommendation to enter a new trade, and we also send out an email if we're closing out a trade. So we put the new trade in the open trade portfolio, and then each day the prices are updated real time, so you can see how each trade is doing. And then we also, every time we close out a trade, we maintain a closed trade portfolio so that we account for all the trade recommendations that we give out. So if you want to see how, you can see we have several portfolios here in the weekly option advisory. And if you want to get an idea how these portfolios are doing currently, if you go to weeklyoptionalert.com and you click trade results, you'll see how these strategies are performing. We have both the open and closed trade results if you click trade results right here. So if you're interested in the advisory service, you can call Brad at 866-661-5664, or 310-647-5664. So, or log on to weeklyoptionalert.com if you want to get further information on the weekly option advisory. So that concludes my presentation, and I'd like to take questions at this time.
All right, we have a few.
Okay.
We have quite a few that have come in, and a lot of them I was answering the ones I could, like how does this work in Metastock and that kind of stuff. But let's just kind of take a few. I don't think we'll get to all of them. Do you so let's just say this: if people have questions that aren't addressed, would their best bet to be to call Brad to talk to him about it?
Yes, yeah, they could call Brad, or if you log on to the website, you can also send us an email. Just click contact, and it'll give you an email address, and you can certainly send us an email, and that goes to my sons that work with me, and we will get any questions answered.
We'll start with an easy one. Keltner channel. You pretty I believe based on kind of the looking that I did, you're using a 20-period Keltner channel. Is that correct?
Yes, I use the default channel. Yes, that's correct.
Anna, I just answered your question for you. I didn't want to type that as an answer because I hate it when I type something and it turns out wrong. So I was just kind of curious. I was pretty sure about that answer though. So Mike asked, will it work for a very small account? I mean, a total cost of a trade that is about $100, not like $1,200 like Apple.
Oh, you mean a total account of $100?
No.
Total
trade size of $100.
Oh, yes, you could. In that portfolio I showed you, there was 6 spreads, so that's 12 options, and the total cost was $17.15. So they were just over $100. They're about $150 on average for one contract for that portfolio that I showed you the snapshot of. So you could do it with $100. Probably realistically, it would work better if you could spend $300, $400, $500 on the option, because don't forget, you're going to be buying an in-the-money option initially before you leg into the market neutral spread. So those in-the-money options using the 1% rule, they're going to be more expensive. So realistically, you would pay probably closer to $500, $600 on those in-the-money options.
Okay, and yes, Annie, 20 for the Keltner channel. So that same question came in again, so I guess we weren't clear. What is the average trade time for you, Chuck?
That's a good question. We normally go 2 to 3 months out, and now on the call purchase, we can go further out, maybe 3 or 4 months. But when we buy the put option, that's usually 2 to 3 months out, the protection. But we're longer-term traders. We don't follow the market closely. We just check our portfolios once a day, and we're longer term, and we go out several months on these trades.
Okay, awesome. There was one more that I was seeing that kind of seemed like we could kind of take a stab at it. I kind of lost it though. How do you determine the ratio? Robert asked this question. How do you determine the ratio number of puts needed to protect calls in a winning trend?
Oh, it's a simple 1-to-1 ratio, because with the call option, that covers 100 shares of the stock, and the put option covers 100 shares of the stock. So it's a simple 1-to-1 ratio.
Okay, I think that's time for us. If you guys have more questions, I'm sorry we didn't get to all of them, but give Brad a call, 866-661-5664. There are still a lot of people asking to see how this works in Metastock, so I'm going to take a few minutes and do that, and we can come back to this after. I can show this again if you guys want after Barry is done. Barry's, well, aside from me, our last speaker of the day. Chuck, I want to thank you for your time. You did a great job.
Okay, thank you, Jeff, and thanks for putting these on.
Yeah, of course. Thank you. Okay. All right. So let's do this. mute Chuck. I'm going to take back the presenter role. And I'll just very, very quickly, because we kind of do run into time. And I think we might change the format a little bit for our next sessions, which we're going to do in September, just to kind of accommodate more QA. So, but people want to know how this works with Metastock, and I want to show it, honestly, because it's a very, very simple method. It's one that he's obviously proven that's been working really, really well. He's won the Trading's competition with this. Step 1, determine the price trend. Step 2, confirm the price trend. Step 3, determine a low-risk entry point. Well, Metastock actually takes care of all of that for you. Okay, so if I go into the Metastock program, and I want to find stocks that currently have a opportunity to buy, that have 1, 2, and 3, the determined price trend, the confirmed price trend, and the entry point using the Keltner channels, I can very, very easily do that. And what I would do is simply, let's see if this works. Okay, cool. Now I'm able to use my webcam again. Is you click on the Power Console right here. Okay, you come to the scan button. We had the question earlier, how does Metastock really help me with this stuff? Like, what kind of stuff can it do? Well, here's a great example of how it's going to help you. If I just come in here to the Chuck Hughes basic or high probability system, I can actually say, okay, out of the stocks I'm interested in, show me the ones that kind of have a buy criteria that'll match for today. Right? And because we have so much data that's still, let me just scroll up a little bit for you, because you can literally scan this against just about anything that you want. In Metastock right now, I could scan 398,811 issues, which is just ridiculous, and you're not going to do it, right? But that covers Asia, it covers Europe, it covers North and South America. So if you're interested in doing this in London, you can just come down here. You're going to find the London Stock Exchange, and you can run that scan. Easy to do, right? Same with India. We have had a lot of questions about India today. For most of you, you're in America based on kind of the polling I did this morning, and so you're going to be interested in more the North American stocks. So right here you can come, and we actually have a list of all the U.S. optionable stocks that you can run a scan against. You just put a check mark there, and you can run this scan against 4,375 optionable stocks. Okay. I'm not going to do that because it takes a few minutes and we don't have time. What I did is I ran this against the S&P 500 a little bit earlier, and the report that you're going to get back looks just like this. You just get a list of tickers that currently have confirmed the price trend, verified the price trend, and meet all of the requirements for a Chuck Hughes buy. So you can take this, you can save it in Metastock, and you can look at them one by one. Now, this is in the chart. This is a chart that I was just looking at to kind of give you an example, but let me go back into the chart and show you really how the expert works. Any of these blue areas are areas that are a confirmed buy. So they've had all 3 of these components met. At the 50-day is above the 100-day. It's had a 52-week high within the last 4 weeks of trading. The on-balance volume matched up, and it's in the range of the Keltner channels that Chuck is looking to buy. So it just identifies them on the chart for you. It allows you to scan for them, and once you're in a trade, it's going to tell you right now you're on a basic blue buy. Now this is this day, right? Just to be really, really specific. But then it's going to tell you what all the rules are, just to remind you what you're looking for. And if you come down here a little bit in the commentary, it's going to tell you what the suggested exit guidelines are to get out of this stock if you bought into it. It will also track these. Now, obviously, we haven't hit a stop here yet in this Apple trade. It's kind of brand new. But if we come back in the past, we should be able to see other areas where it's actually telling us to get out of a trade. Let me scroll back a little bit here. So here we had some other buying opportunities. Here's telling you to sell a third of your position. Here's telling you to sell a third of your position based on a type 2 stop loss, okay, which you can kind of come over here and it tells you exactly what type 2 is. So really kind of, it's designed well. This was written by Chuck Hughes' team, and they did a really, really good job with it. It basically tells you everything you need to know and kind of compartmentalizes it up for you. So hopefully that's helpful for you. That's exactly what I have time to show you. And we can go into a little bit more detail for you. Let's go ahead and kind of skip here a little bit. This is an add-on for Metastock. I think these add-ons provide such a lot of value because, you know, just look at the pedigree of the people we've brought in today. You know, we had Steve Bigelow, who's very popular. We have Price Headley, who's a proven winner. And now Chuck Hughes. Chuck Hughes has won so many world trading competitions and showed you his brokerage statements right there on the screen. and you can kind of implement their methodologies, and it's a very, very reasonable price. Like, so for example, if you want to get this expert advisor and this kind of set of tools into your Metastock, you can just buy it. It's a one-time cost. It's going to give you the scans. It's going to give you the expert advisors. It's going to give you the commentaries. And it's a one-time cost of $3.99 here at the show. It's normally $4.99. So you'll save $100. It does, as everything else that we sell here has, a 30-day money-back guarantee. So you can try it. If it helps you with your trading, well, then I think you'll agree with me. It's worth $400. If it's not, well, there's your low-risk entry point, right? So give us a call. We're here. We're here to help you. It's 800-882-3040. You can also visit us online at metastock.com/saleschat. And we have one more speaker. After that, well, two more if you count me, but we can kind of go into a little bit more detail about this. I have some other things I want to talk to you. My 3 favorite things about Metastock is actually what I'm going to be talking about. So in any case, give us a call, 800-882-3040. There's a few items of business that I wanted to talk to you about. These questions are coming up all day, so let's talk about them. Recordings. So obviously, we're going to have about 9 hours of video here, right? And the recordings will be available. My video team, they do a really good job of including them and putting them up on YouTube. It takes them a few days to do that. We'll probably have them available by Wednesday at the earliest, but definitely next week. When they're available, I will email you a link to all of the recordings. So that's how the recordings work. Bonus offers. When you registered, all of the presenters here today had freebies that they gave out. What's going to happen for those bonus offers is on Monday I'm going to send everybody, all the people, I'll send them your information so they can email you how to take advantage of that bonus offer. And if you've seen a speaker and maybe you didn't opt in for a bonus offer, if you go back up to metastock.com/tradersummit, you can still opt into those bonus offers if you wanted those freebies. And that includes the Chuck Hughes ebook, includes basically all the freebies that were offered today. You want to do that today, though, and the reason is the site itself will automatically archive. I believe it's at midnight tonight, okay? And we answered the question about Keltner channels, and we answered the question about pricing. There are a lot of questions coming in. Just to kind of stick into time, don't worry, guys. After Barry is done, I'll answer every question you've got. We'll stay here as long as we need to. Okay. We're going to talk about 4 total add-ons today. They're listed on the screen for you. If you buy one, we're going to give you $100 off. If you buy 2, we're going to give you $150 off. If you need Metastock, we will provide a trial subscription to you for 30 days. So again, no risk there. And you're also, just by buying it, even if you return it, you're going to get 2 years of Stocks and Commodities magazine. And I will be running a special boot camp for everybody that's signed up to kind of give them advice on how to get started, how to run scans, how to manipulate the platform, all that kind of stuff. And we're going to provide you a lot of training as well. So, all right, Stocks and Commodities. I want to say thanks for them for sponsoring the event. Love these guys. Love the magazine. If you didn't sign up for the trial issue, make sure you do that. You still have until midnight to actually do it. And great magazine. Like I said earlier, I've had this magazine delivered to us north of the 20 years I've worked here at Metastock, and it's a great magazine. I don't need to preach to you about the importance of education. You came to a 9-hour class. This is a great way to make sure that you're kind of getting new ideas on a regular basis. Some of them, if you incorporate into your trading, are going to be helpful, and some may not be. But it's a great way to kind of continue to kind of learn. I believe you're always getting better, or you're always getting worse. And it's just, I think, the way of life, right? Okay.